This changes everything. We are all facing the prospect of paying much higher rates on our mortgages. Currently in the UK, a 5-year fixed is at 5.3%, whilst in the US you're looking at 7%. It's as clear as day that paying off your mortgage as fast as you can has got a lot more attractive, and for many of you, this will need to be your primary focus. But for others, the decision is not that obvious, and you may be wondering whether you'd still be better off investing. To answer this question, we need two things. Firstly, some way of estimating what returns we should expect from investments in the future, and an understanding of the risks we need to take to get them. Using historical averages is what most people rely on, but as I'm about to show you, that can be very dangerous. So in today's video, I'm going to take you on a journey as we explore what drives investment returns and the risks we need to take to achieve them, so that you can decide what's best for you. Welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and this is a place where you can learn to make smarter financial decisions. Most people want to pay off their mortgage as fast as they can, and there's two main strategies you can use to get there. The first is to simply use any spare cash you have to overpay your mortgage as fast as you can. The second strategy is to instead invest that spare cash into something that will yield a higher return, and in the future, use that investment to pay off the mortgage or just keep on investing. And if you can find an investment that will deliver you a return that is twice the interest on your mortgage, you'll pay it off twice as fast. The only problem is that there are no investments out there that can guarantee you a 10% return. There are plenty of investments that might, but there's always a risk that they won't. Now, before you even consider investing, you first need to make sure that you can confidently cover your mortgage payments in the future, even if rates go up to 6%. You also need to make sure that you have a good emergency fund of at least 3 months worth of cash to fall back on if you lose your job or if something bad happens. Given the rapidly rising and unpredictable costs that we are facing, I have personally been increasing my cash buffer to 6 months of core expenditure, because I know that if I'm worried about my short-term cash flow, I'm not going to be able to make good long-term investment decisions, and I'm always going to be stressed about what's going on in the markets, and that's going to lead me to making mistakes. But if you already have these two things checked off and you have spare cash left over at the end of the month, then you're probably asking the question of, should I be using this to overpay my mortgage, or should I be investing? The answer to this question will not be binary, and it will be personal to each of us. But to answer this question, we need to know three things. Firstly, what return should we expect from investments like stocks in the future? What risks do we need to take to achieve them, and are you comfortable taking those risks? So let's get into it. We all have different tolerances for risk, and here is evidence of that. Last week, I posted this poll that presented you with two long-term investment options. A risk-free investment that yields 4% per year. B, a Vanguard S&P 500 ETF. Assume you start with all of your money in A. What return would you need to expect from the S&P 500 before you would start shifting your money into it? If I told you the expected return of the S&P 500 was 4%, would you invest in it? No, of course you wouldn't, because the stock market is risky, and there's a good chance you may end up with a return that's less than 4%. But what if the expected return was 10%? What is the minimum expected return you would require before investing in B? Looking at these answers, which group of people do you think are the most risk averse, and which are the risk takers? Well, we know that investing in the stock market is both uncertain and painful, but these group of people are willing to take on all of that just for a tiny fraction more of a return. These are the risk takers, whereas the other end, some people would not leave the shelter of a guaranteed 4% return unless the stock market was offering an expected return of 15% or more. These are the more risk averse. There's no right or wrong answer here. We're all individuals with our own preferences and personal situations. But as you're about to see, the demand for risk is a big driver of what returns we should expect in the future. Now, another thought experiment. I'm going to do this in dollars because the data that we're going to be using is US based, but the same principles apply wherever you are. If I offered you an investment that is certain to pay you $1 a year for the next 10 years, how much would you pay for it, assuming that you get your money back at the end? How would you work out the value today of receiving $1 a year for the next 10 years? Would you pay $100 for it? That would give you a 1% yield. Is that any good? Well, you can currently get a 4% yield on both UK and US 10-year government bonds. They're not entirely risk-free, but if you hold them to maturity, that's as close to risk-free as you can get. So if we wanted a comparable 4% yield from this $1 of cash flow, we'd be willing to pay $25 for it. Now, what if I presented you with another investment that also pays $1 of cash each year, but there's a risk that you might get back slightly less than you originally invested? How much would you pay for this? Well, you're obviously not going to pay $25 for it, but how much less should you pay? Well, that depends on how big the risk is, right? The higher the risk of losing money, the less you're going to pay for it. This is a good point to explain what do we actually mean when we talk about risk when it comes to investments. One definition of risk is how likely is it that the actual return we receive will vary from the return that we expected at the beginning of an investment. As an example, a 10-year US government bond that yields 4% has an expected return of 4%. And we can be very confident that if we hold this bond for 10 years, our actual return will be 4%. There is no deviation between the expected return and the actual return we receive. But with a more risky investment, there will be a large distribution of possible actual returns. Take stocks for an example. Since 1928, the S&P 500 has delivered an average annual return of 11.82%. But the variability of that return from year to year has been enormous. There have been years of minus 40% and then years of plus 40%. But this is only over a single year. If we plan on holding stocks for 5 years, the distribution of returns gets much narrower. And over 10 years, it's narrower still. This is why stocks are tools for long-term investors. Over 1 year, you're just gambling. But over longer periods, stock returns are much more reliable. Saying that, there have still been 10-year periods when the S&P 500 has underperformed government bonds and even been negative. But this is the risk we take on as investors, and that is why we demand a higher expected return for taking on that risk. And we can see this happening in the real world. As an example, what is more risky than investing in US government bonds? How about corporate bonds, where instead of lending money to the US government, you are lending it to a business who are more likely to default on that debt? Ratings agencies like S&P or Moody's rate companies' debt according to how risky they perceive it to be, with a AAA rating given to the most reliable companies like Microsoft and Johnson & Johnson down to BBB companies, which is companies like Daimler or Hyundai. This top section are the most reputable companies, and they're also known as investment-grade bonds, whilst anything below that rating is known as junk or high yield. As we've learned, investors demand higher returns for taking on higher risks, and AAA-rated corporate bonds are seen to be slightly more risky than investing in government bonds. That's why they are currently yielding 5%. BBBs are yielding 6%, and junk bonds, the riskiest, are yielding 8. You'll notice that in this example, each category is still paying out $1 of cash flow, but to give us the higher yield, we're just paying less for it. This demonstrates that inverse relationship between price and yields. As yields rise, prices must fall, and vice versa. A better way to visualize the difference between these rates is through a spread, which shows us what additional return or premium above a government bond the market is demanding. Now you might be thinking, how does inflation fit into all this? Because as an investor, I'm only going to take on risk if I'm going to get a return that is also above inflation. And you're right, because as an alternative, you could just go out and buy an inflation-protected bond, known as TIPS in the US or an index-linked bond in the UK. They're a special type of bond that adjusts their payments in line with inflation each year. They're currently yielding 1.5% right now. So you can be confident that if you were to buy that bond today, you'll get 1.5% each year in excess of inflation. But a normal 10-year government bond does not offer these protections. Therefore, as investors, we demand it pays us a higher yield to compensate us for that risk. Therefore, with a current yield of 4%, the market still expects to get a better return by investing in a normal 10-year government bond than with an inflation-protected bond. This shows us that the market is expecting inflation to be less than 2.5% per year over the next 10 years. Now that may seem low to you, but you need to remember that the market represents our consensus view as investors. So I hope you can see that inflation expectations and the risk of future inflation changes are already baked into the expected returns you are seeing here. This concept can be very hard to get your head around, so please do ask me any questions down in the comments. So as we've seen, whether it's inflation risk or the risk of default, investors always demand a higher expected return for taking on those risks. But what return should we expect from stocks? With a bond, we can work out its expected return because it promises to pay a fixed cash flow each year, and we know the current price we're paying for those cash flows. But the reason we invest in stocks is also for the cash flows that they produce. The only problem is that unlike bonds, they don't promise us anything. When a company makes a profit, it can either pay that profit out to investors through dividends and share buybacks, or it can reinvest those profits back into the business to grow its capital value. These profits are known as earnings. Now clearly $1 of expected earnings from the S&P 500 is not going to be worth as much as $1 of expected earnings from a government bond. But how much should we pay for those future earnings? At this point, most people default to using historical returns to work this out. If, for instance, the S&P 500 has delivered 12% a year on average, that would give us an 8% premium above the current yield of a government bond right now. But using historical averages is not an effective way to estimate future returns. Let me show you why. If the yield on government bonds went up to 9%, what do you think would happen to the yields of these other bonds? We would expect them to go up too, as investors demand a higher return for their additional risk, which means that prices would fall. We'd also expect the same thing to happen with stocks. We can see evidence of that here. In this poll, I asked the same question as before, but increased the return of the risk-free alternative to 9%. And as expected, the return that you said you would require to invest in the S&P 500 shifted upwards, with most people now requiring a 13 to 15% return. So do you see how there must be a relationship between the yield of government bonds and the expected return of risk assets? Therefore, using the average return of the S&P 500 to estimate future returns does not make sense. A better solution would be to find the average additional return or premium that stocks have delivered above government bonds. Well, since 1928, that premium's been 6.25% on average. This is known as the equity risk premium, the additional return investors demand for taking on the risk of stocks. So with government bonds currently yielding 4%, that would give us a long-term expected return for the S&P 500 of 10.25%. But there's another problem. Do you think that the equity risk premium has been constant over time? No, it hasn't. Just like all other premiums, it varies depending on how risky the market perceives stocks to be at any one time, and the demand for that risk. Demand for risk plays a big part in expected returns. Imagine, for instance, a world in which all investors were as comfortable with risk as these guys here. How do you think this would change risk premiums? Well, they would probably look much flatter because there's so much demand for risky assets, which would push up their prices and lower expected returns. If 6% was what they were willing to accept, well, 6% is what they'll get. But if we lived in a world where everyone was scared of risk, they might look more like this, because everyone is piling into these safe assets unless stocks are offering much higher returns. And our collective appetite for risk changes over time. Just think back to this time last year when the stock markets were roaring and sentiment was high. You probably felt a little bit more willing to take on risk, and that's why money flowed into risk assets, pushing up prices and reducing expected returns. Whereas now, the opposite is happening, and perhaps you've stopped or maybe slowed your monthly investments, which means that money is flowing away from riskier assets. Normally, this would push up the price of safe haven assets like government bonds, as has happened during other market crises. But because interest rates have been rising, we're in this very strange situation where the price of both stocks and bonds has been falling at the same time. But falling prices often means higher expected returns in the future. It's easier to see how premiums and expected returns have changed over time when you look back at historical bond yields. In yellow, we have the yield on a 10-year government bond. In red, AAA rated corporate bonds, in blue, BBB rated corporate bonds, and in black we actually have the US mortgage rate. The first thing that you'll notice is that clearly there is a strong correlation between government bond yields and the yield of more risky assets. And if we look closer, you'll notice how the spread between each changes a lot. Sometimes they're really wide, like during stock market crashes, and other times they're very narrow. And here we can see how these yields have risen dramatically over the last 2 years. And because of this, we would assume that expected returns on stocks would also have risen too. But how can we work out if that's actually happened? With bonds, we can calculate the expected return because we know the cash flows they will generate in the future. But with stocks, we don't know exactly what they'll be, but we have a pretty good idea. There are thousands of analysts around the world whose job it is to estimate companies' future returns. They're not perfect and they're often overly optimistic, but we can take those estimates and the current price of the stock market to arrive at an expected return or an implied equity risk premium. Just as with bonds, if the price we're paying for those future earnings is high, our expected return will be low. Whereas if the price we're paying is low, the expected return will be higher. This is a particular technique that is championed by Aswath Damodaran, a professor at NYU who actually posts all of his lectures on YouTube, and I would highly encourage you to check them out. And he has used this technique to calculate the implied equity risk premium going back to 1960. And that's what you can see here. In blue is the yield on a 10-year government bond, and in red is the equity risk premium. You'll notice how the overall expected return has reduced as bond yields have fallen, but the equity risk premium has stayed fairly robust. By the end of 2021, just before the market crashed, the equity risk premium was at 4.24%, which is as low as it had been for quite some time. But the overall expected return of 5.75% had not been that low for over 60 years. This indicates that the expected returns of stocks are likely to be much lower in the future, caused in part by low bond yields, but also by very high stock valuations. Now, you might have been thinking that surely this was an indicator that you could have used to get out of stocks. Well, firstly, into what? The expected return on all assets was low. And an expected return does not mean that there will be a stock market crash. Firstly, valuations could become even more stretched and the stock market could go even higher. Or we could just see a long period of low stock growth as earnings grow into those valuations. We didn't know how it would materialize at the time, but we do now. And we can see here how the recent stock market crash or revaluation has affected expected returns. This is the same data, but since the start of 2021. In green, we have the yield of a 10-year government bond, and in red, we have the implied equity risk premium. And we can see that since the start of this year, bond yields have been rising while stock prices have been falling, which has pushed up expected returns to 9.75%, the highest it has been since 1990. In other words, stocks or the earnings that they produce have got a lot cheaper. That's not to say that share prices won't fall even further, but if they do keep falling faster than earnings expectations, then they will continue to get cheaper. It's important to remember that this is just an estimate and it is based off assumptions, but it is more accurate than using historical averages. And if you want to find out more about this, I have left a link to Aswath's content down in the description of this video. So there we have it. 9.75% is our best guess at the expected return for the S&P 500. I appreciate that this has been a very long-winded way to get to this answer, but hopefully you've learned a lot along the way. So finally, how can we use this data to help you decide what to do with your mortgage? Well, firstly, you're not going to be investing in just the S&P 500. Instead, you should be investing across the globe. So given that, and the fact that this is just an estimate, let's be conservative and assume that stocks from this point are expected to produce 8.5% per year on average over the long term. Now, you may want to reduce this return further if you expect to pay tax on your investments, but if you're using a pension or an ISA, then you don't have to worry about tax. In fact, you may even be able to enhance this return through tax relief on pension contributions or employer contribution matching. Then we need to remember that although this is an expected return, the actual return we get could be much lower. Over 1 year, we could lose another 20%, we could gain 20%, but over 5, 10, or 20 years, the dispersion of returns is likely to be much narrower, and our chances of loss reduce. We also need to remember that this is not a binary decision. It's an equilibrium. At one extreme, you have using all of your available cash to overpay your mortgage as fast as you can. And on the other extreme, you have switching to an interest-only mortgage and using all of your cash to invest. In reality, you're going to end up somewhere between these two, and you could argue that just by having a repayment mortgage, you're already somewhere in the middle. If you're lucky enough to have a long time left on a low fixed rate, it probably does not make sense to overpay your mortgage right now, especially when you can get a 4% yield in a government bond or a fixed term deposit, which is what I covered in my last video. But when you're facing into a mortgage of 5%, the 4% premium being offered by stocks is not as attractive as it once was. So for those of you who are not comfortable with risk, you should be leaning towards paying your mortgage off faster, especially as you may not be comfortable investing in 100% stocks in the first place. So the return that you can achieve through investing is likely to be less than 8% anyway. But for those of you that are comfortable with risk and have a long-term investment horizon, you may want to keep on investing because over the long term, stocks are expected to produce a higher return. I'm hoping that now you've seen all of this data, you've got a feeling in your gut of what is right for you. Personally, I think diversification is very important. You don't want all of your eggs in one basket, and that includes having all of your money invested in your own home. Now, even if the stock market is expected to return 8%, the chances are that the returns that you receive will be much lower. And if you want to find why that is and how you can stop it, watch this video here.